Well, hello, everyone. Welcome to our 12 p.m. second session in our new investor workshop today. My name is Dave Whitmore, and I have the honor of beginning the process of talking about actual investing. In our first session, Aaron did a really good discussion of the foundations of personal finance, making sure we understand how to budget our income and our expenses, talking about managing debt, really important, obviously, which a great case was made for having emergency funds and establishing that as our personal finance baseline. But then we start to build up savings, and it becomes prudent to invest those savings. And so that's what this session is all about, to sort of set the foundation and the basic level of how does investing work and why. And then we're going to continue on. We're going to, in our session following, we'll look at mutual funds and ETFs. Then we'll take a look at some platform stuff so you can get used to using the E-Trade platform for doing the kinds of things we're talking about. And then we'll finish the day with actually talking about making a stock trade, and then looking at what else is out there. What are alternative investments? So I do want to bring up our disclosure slide and make one concrete point. Please don't take our conversations here as advice. This is education. There will be times when there will be perhaps real securities being shown on a screen. Those are being used as examples. Please don't take anything as a recommendation. All right, so let's talk about investing. And I want to sort of lay this out in 5 different steps. And the first question is why? Why should I invest? Then we'll talk about the building blocks of the kinds of investments that we'll see out there. We'll do a little dive into risk versus reward. We'll talk about building a portfolio, and then we'll finish out with the most important first step, and that is the process of funding your investments, getting money into a brokerage account and getting it working. So why? Well, the first reason is because of inflation. And right now, this is a super strong point that is hitting everybody's consciousness. I've used this slide many times in the past when we had virtually no inflation, and so it wasn't as palpable as a point. But this is the first reason. If you just save your money in cash, in the coffee can, under the mattress, whatever, it won't achieve any return. And therefore, its purchasing power will be reduced because prices will rise. Of $100 today, it buys you something. 2 years from now, that $100 is going to buy you less because prices have risen. So that's the first reason we invest. We have to achieve some sort of a return. But the real reason is because we're trying to reach financial goals, whether that's accumulating wealth, reaching retirement, funding education. These are the real reasons why we take savings money and employ it into investments. And so that's the why. But there's one more why, and that's because of the power of compounding returns over long periods. In our first session, Aaron showed an example of how compounding works. And in his example, he's showing 3 different investors that began their savings at different stages in their life and how their outcomes worked. Here, what I'm depicting is if you invest $10,000 today and achieved any one of the 5 interest rates that I'm showing here, 10, 8, 6, 4, or 2, then at the end of 25 years, you would have those numbers. So if you achieved a 10% return for 25 years, if you invested $10,000, at the end of that period, you have over $108,000. If you only achieved an 8% return, you would have $40,000 less. That 2% difference is really important. These small percentage differences over the long run are very important in the long-term outcome of the investment strategy. One more point about that, this also highlights that if your investment expenses are high, it can pull down your return meaningfully. So that's one of the reasons why we seek low-cost investments. We'll talk about that more when we talk into situations with mutual funds and exchange-traded funds. Now, in this picture, I also want to bring up something that my colleague Rick brought up in the first session. It's called the Rule of 72. And it's a little rule of thumb that you can use to try to project what kind of an outcome of an investment you might gain. And the Rule of 72 is simple. I take 72 and I divide it by the rate, not 10%, but in this case 10. And that tells me that in 7.2 years, my $10,000 would become $20,000 if I achieved a 10% rate of return. And then you can see the rest of the numbers here. It's simple arithmetic, but it just simply underscores again the differences that small percentages make in your ability to reach a financial goal. So starting early and being in for a long period of time are vital steps in achieving this wealth generation, this wealth accumulation, this paying for retirement process. So that's the why. Now let's turn to the nitty-gritty, the more specific stuff here, and we'll talk about the three basic investments: stocks, bonds, and cash. So there are three basic ways that companies raise money. They sell stock to investors. Those investors then become partial owners of that company. When you buy stocks, when you invest in stocks, you can make big money, but you can also make big losses. Companies do go belly up, so you take on that risk. But you also have the possibility of investing along with some bright people who create profits over the future, and your wealth builds along with them. And by the way, that's really how you make money with stocks, is the price going up. There are dividends. Some stocks pay dividends, some don't. But at any rate, that's the world of stocks, and we also call that equities. So if you ever heard the term talked about an equities, or this is an equity portfolio, that just means stocks. The cousin of stocks are bonds. And bonds don't represent ownership. They represent a loan. When you buy a bond, you have effectively lent money to a company or a government, usually. When you buy a bond, when you own a bond, and this is sort of like a CD too, you receive interest payments. Bond values can also fluctuate, but they generally fluctuate less than stocks. And we call bond investments, the world of bonds, the fixed income market. And then cash is the third, and it is considered an asset class. But here, let's make sure we understand this. We're not talking about dollar bills. We're talking about savings account, money market funds, investments in very short-term interest-bearing items like a money market account. Now, with cash investments, putting money in a money market account, you achieve a very low return, but it doesn't fluctuate. So it's these are the building blocks of mutual funds, exchange-traded funds. Many markets like futures and options trade around the prices of stocks and bonds. So these are the basic, essential, I've used the term a couple times now, building blocks of the investment world that we're going to continue to learn about. So let's look at those asset classes a little more closely. So we have stocks and bonds, but I want to make sure that we learn to not think about stocks as being just stocks, that there are very many different pockets of types of stocks. And it's important that we learn about these as we go along. So for instance, when we talk about stocks generally, there are large company stocks like the companies that you probably know, the Googles, the IBMs, the Disneys, the Bank of Americas of the world. And there are small company stocks, many of which you probably have never heard of. The difference between large company stocks and small company stocks is important. And it is something that we will talk about more as we move along here. Then there are stocks in foreign companies. Then there are also stocks that we call growth stocks and others we call value stocks. And their growth stocks and value stocks are different kinds of animals. And it's important that we learn what that means. And then within stocks, there are stocks in technology companies, there are stocks in healthcare companies, and those are different kinds of industries as well. So stocks are not just stocks. There's a bunch of different types of stocks that behave differently in different market environments. On the other side, bonds are generally divided or thought of in terms of who the borrowers are. So, for instance, U.S. Treasury, various government agencies. companies issue bonds. Municipal bonds are local governments, like your school district or state bonds. And then we also look at bonds, short-term bonds and long-term bonds. The maturity length, the length of time in that bond is a factor of how we look at bonds too. We're not going to be talking about bonds much more here specifically, but we're going to be talking about portfolios that use stocks and bonds. And now I want to clarify, in a way I fibbed a little bit, because there really is another category of asset class, and that's called alternative asset classes. So for instance, investments in real estate, investments in commodities, or crypto, for example, would be categorized as what we would call alternative investments. So now we've learned a little bit about these different types, and you've already alluded to the difference in stocks and bonds. And I've said with stocks, you can have big wins or big losses potentially. With bonds, they're more moderate. And then I talked about cash being stable. Well, let's develop that a little more. So I want you to take a look at this data here. Here is the monthly change in the Standard & Poor's 500 index. So it's the monthly change. The purple lines are months where the S&P 500 was up. The white bars are where the S&P 500 was down for that month. Now, when we see a bunch of data like this, one of the things we can do is apply a little high school math, depending on what level you might have taken it. But when we look at statistics, one of the things we do is we take the average of a bunch of numbers, right? So here, what I've learned is by averaging all of these numbers, I find out that the average monthly change was plus 0.78%. But that's not all, because if you recall, one of the other things that we can measure when we measure the average of something, called the mean, if you'll recall, is we can calculate what's called the standard deviation. Remember that? We're not going to do the math, but standard deviation tells us about how much fluctuation is in this information. In other words, how much variation is there around the average? And so what we do is we do the calculation of the standard deviation, and then the application is that if we add it and subtract it from the average, we will capture about 2/3 of the values. So most of the time, the return is going to lie in that range. And then if we take two standard deviations, the assumption is that 95% of the time, the return is going to be within this range. The main point here is simply that this idea of measuring the variation in the returns of an investment from period to period is how we can measure risk in investing. So let's hold on to that now and turn to the trade-off between risk and reward. So imagine an investment. Let's say you've got money in a bank account and it's earning a low return, but it doesn't fluctuate very much. But you've come to the conclusion that you need more return. That the 2% that you're earning here is not going to be enough to fund your retirement. So you need to move up in the potential return line. To get there, you have to accept more risk. And then if you have a risky portfolio that you're not comfortable with and you want to reduce the risk, you have to accept a lower return. This is like gravity in investing. It is an undeniable fact. If you want to reach for more return, if you want to achieve higher return, you are definitionally accepting more risk. Notice that there's a curve to the line, too. It can't go on forever. The idea that there are diminishing returns for taking more and more risk. So this concept is at the heart of so much of portfolio construction. The idea of making that pie, that pie chart that your investments are divided up into, and the why, which is where we're trying to get here. So now going back to our three little asset classes, we can see that it's cash is down on the low end of the spectrum here, bonds in the middle, and stocks up top. So now I want to dig deeper into stocks versus bonds. So there's an interesting relationship, and that is that stocks and bonds historically often move in opposite directions. So here's a period from 2008, and you can see in the beginning is the 2009 credit crisis stock crash. But take a look at how often through this period when stocks are falling, bonds are rising. When stocks are rising, bonds are falling. But often the bonds are falling at a more gentle rate than stocks. These facts, when put together, shows us our first step into building a portfolio. Now, I've just put up the performance table here for the bond that I'm using here, not as any part of my point, just to make sure that because I'm showing the investments in an ETF, I'm showing the historical return, but it's not really an important part of our conversation. So now it's build a portfolio. So take a look at a little hypothetical exercise that I asked the folks at E-Trade Capital Management to do. I said, I want to see a long-term period, and this is a 30-year period, where 5 different portfolios of stock and bond mixes, what kind of returns would I have received and what kind of risk or standard deviation would I have seen? So take a look. So first off, had you in 1989 put your portfolio 100% in stocks, through the end of 2019, you would have achieved about a 10% return, and your standard deviation of those returns would have been 14.2%. Now you can do your math, add the 14.2 and subtract the 14.2, and that shows you that range of 2/3 of the time your result was found in that range. On the other end of the scale here is a portfolio of 100% bonds. And had you invested 100% in U.S. Treasury bonds, actually this is the Barclays Aggregate Bond Index, so it's just a general level of bond returns, you would have gotten a little less than a 6% return per year, but with much lower risk, standard deviation of only 3.6%. And now, what about the portfolios in between? Well, if we took that 100% portfolio and just put 25% of it in bonds, we would have received a return of 9.3%, and we would have reduced our risk measure, our standard deviation, down to 10.7. A 50-50 stock and bond mix shows 8.3%, and a 25% stocks, 75% bonds shows us a 7.2 and a 4.6 standard deviation. And yes, there's that curve. And so here I've simply shown on a table what percent of the return you get and what percent of the risk you took on. And I think, a big story is just found in this first move here. Simply taking a small slice, a quarter of a portfolio, and putting it into bonds dampens the volatility of the portfolio meaningfully without giving up all that much potential return. Now, where one lies in these areas, which portfolio makes sense for you, well, that requires us to talk about risk tolerance. So I just showed an example of just using a hypothetical portfolio of stocks and bonds. But remember, when we looked at stocks, we found that there were large cap stocks and small cap stocks. There were foreign stocks. When we talked about bonds, there were long-term bonds and short-term bonds. So there's more than just, a stark stock and bond mix. There's more that we can add to the pie to move the dial up and down this curved line. And so the question becomes, one of the key drivers of where you personally end up on this has to do with what is called your risk tolerance. Risk tolerance is something that is difficult for you to probably express right away. So one of the techniques is that a financial advisor or an online tool, such as you'll find at E-Trade, will sort of walk you through a sort of Rorschach test of how you feel about risk and return. And so one of the techniques is to show you some examples, like which would you like best of these three? So here's a conservative allocation. We'd say, well, if you invest in a very conservative portfolio, and you looked at your portfolio a year from now, you might see you were up 15%, or you might see you were down 14%. But chances are you're up 5%. If you were to build a more moderate portfolio with a little more risk, well, your expected return now is 7%, with the possibility of a big year being plus 24 and a small year down 23. Or to move to more aggressive allocation, we would be expecting an 8% versus a range of 36 to 27. And so, as I said, online tools at E-Trade sort of quiz you in a variety of ways to sort of ultimately arrive at an assessment of what your risk tolerance is. And when your risk tolerance is assessed, and we know how much money is to be invested, and we know how much you plan to add to it, you can plan for reaching a financial goal. Those components come together to create a suggested portfolio based upon your risk tolerance with an expected return that should reach whatever goal you have established. And that's the process that a financial advisor would walk you through, as well as various self-directed tools such as we have at E-Trade. So that all results in the pie. And so here I am showing a hypothetical example of what would be called a growth portfolio, where most of the portfolio is in stocks, with a smaller portion allocated to bonds. So here you can see the purple, the blue, and the green are the four slices of stocks. And as I'm illustrating here, having some large cap stocks, notice I got most of the portfolio in large cap, some small cap, and then some investments in foreign economies. So I've diversified myself across company size and including some international diversification as well. In the bond portfolio, the portfolio is mostly long-term bonds, but a little bit of short-term bonds. If one wanted to tilt the portfolio to a more moderate allocation, then we're just simply going to, I'm sorry, I missed my talking point. At this stage, the vast majority of you would use mutual funds or exchange-traded funds for this portfolio. If you have large wealth, then portfolios can be built using individual securities. These are usually managed accounts where a professional will essentially act as a portfolio manager. Those are very, very large accounts. If you have that kind of money, you probably know about those services and might be interested in them. But companies like E-Trade have self-directed tools that you can use to arrive at a similar place. And again, those tools are always going to use mutual funds and ETFs. And that's why our next session following is to delve into mutual funds and ETFs. And so on the next slide, you can see I've now dialed the allocation of stocks lower. So now we're holding 60% stocks, and we've upped the allocation to bonds. And the bond portfolio now represents 40%. And then if we were to be very conservative, income-oriented, perhaps someone in retirement who no longer needs as much growth in the portfolio but is more interested in capital preservation and stable value and income, well, then we start tilting that portfolio to a greater allocation of bonds. So this is all about the foundation of investing, the why, really. The next part is the process of actually making those investments. So understanding the benefits and the differences between mutual funds and exchange-traded funds, the processes of actually buying stocks, which we will go into. So we'll continue on that path. But at this point, the next thing that I want you to be sure of is how to fund those investments, because one of the things that we know is that new investors often open an account, are not quite sure what to do, don't fund the account, but then at some point later on decide, okay, I'm going to invest now, and then they then have to go through the process of getting that account funded initially, because the initial funding, it takes a couple of days. So let's show how to do that. And then I want to talk about something that you might have heard of called dollar cost averaging. So to fund your E-Trade account, you simply go to the little transfer tab up here. And when you click that, you will see a drop down allowing you to transfer money, do wire transfer, transfer brokerage accounts, all the various ways of moving funds or assets around. And you'll come to a page where you have a variety of ways to transfer. And one of the things that you'll want to do is to set up your bank account. So this is using what's called the ACH system. It's much like what Venmo and PayPal use if you are a user of that. The idea is that the money moves electronically, but it takes a couple of days. Typically with my bank, if I transfer money into my brokerage account, it's usually there the second day. And same thing if I'm withdrawing money. The same function here allows you to move money back to your bank account. So you set up your bank account, and then any brokerage accounts that you also have will be in here, and they will all be in the Transfer To button as well, Transfer To menu as well, so that you can move money back and forth and very efficiently. Now, as I mentioned, an ACH transfer does take a couple of days for the money to move. Verifying your bank account can take a couple of days too. So the initial funding, start it on a Monday and expect that it's probably done by Friday. Okay, and once the money's secure, then you're ready to go invest. Now, if you do have an urgency, you can use what's called a wire transfer. Wires are real time, same day. So if you are attempting to make an investment today, if you get to your bank in the morning with proper wire instructions, which you can get from our website, they should be able to get that into E-Trade and in tradable funds that same day. Now, your bank's probably going to charge you for a wire. We're not going to charge for an incoming wire. They'll come in free. But if you want to wire money out of your E-Trade account, we charge for that too. So ACH transfers, electronic, free, but not immediate. Wires are available for same-day funding. Got to talk to your bank about their policies on it, and it's not free. There's a cost. I think we charge $25, and you should check with your bank on that. The other thing I want to make sure you sort of explore a little bit on this page is the Other Services tab, because there's a whole slew of banking functions and cash management functions that you can utilize for your E-Trade accounts. With bill pay, you can have a checkbook. You can get a debit card, make charitable contributions, make your IRA contribution, make a distribution, all of those things. But two of these I want to draw a little attention to. The first is direct deposit. Obviously, being a disciplined investor, how about treating it much like you would your 401k and set up so that when you get paid, a few $100 come into your brokerage account on a steady basis. And then with that, you can then set up automatic investing. So you select a group of mutual funds or a mutual fund. You make periodic, regular direct deposits. When that money hits, it automatically gets invested into the fund that you chose. And that is a great way to create a disciplined, steady flow and into a diversified investment. And that's a very prudent and practical way to get started. And it doesn't have to be a lot of money. $100. If you make more, then make it 1,000. But that's the idea of running sort of something parallel to a 401k plan that you would probably already have going. And that leads me to the last sort of theoretical thing I want to talk about, and that it's not theoretical, but I mean to see the math behind something, and that's this idea of dollar cost averaging. And I do want to mention we'll have time to do questions This is a scheduled 45-minute slot. I'm coming toward the end, so if folks have questions, you can put them in there. I do know my colleagues are back there, so if maybe some of the ones that have already been answered, they might want to throw them in here so that we can talk for a moment or so. But let's talk about this dollar cost averaging thing, because sometimes you'll hear about dollar cost averaging like it's magic, like it's this great thing that produces profits. Well, look, it can. There are circumstances where dollar cost averaging benefits you greatly, but there are also situations where a dollar cost averaging will lag what we call a lump sum investment. So let me illustrate what I mean. So imagine an investor who decides, I want to get $2,500 invested, and I'm going to do it by investing $500 a month for the next 5 months. So the stock we're looking at is a $50 stock, so his first purchase is to buy 10 shares, and we're going to call this mutual funds. There's no name here, but that's going to allow me to use fractional shares. So we buy 10 shares at $50, and we have $500 invested. And now, each month, we take our $500 and we buy whatever that buys us according to the price of the stock. So the following month in February, the stock's $40. So now I buy 12 and a half shares. In March, the stock's $30. So my $500 buys me 16 and 2/3 shares, and so on. And so in this case, at the end of the period, the dollar cost averaged account has invested $2,500. The account owns 64.57 shares. That's just me adding up the 5 different amounts. The average cost is $38.71 per share. The stock is now 45. So the current value of the 64.57 shares is $2,905.65, and our dollar cost averaging investor is up over $400, even though the stock is down from when he originally bought it. The first trade was 10 shares at $50. The stock's 45 now, but I'm up 400 because I was also accumulating it at lower prices. The lump sum investor, and that's someone who takes the whole 2,500 and puts it into the stock on day one, would have bought 50 shares at $50. The current value of that is now $22.50. So the lump sum investor is down $250. So in this case, the dollar cost average wins. What about here? Here we're looking at the stock is $30. So my first purchase is 16.67 shares at $30. And then the stock goes through a pattern like this. And so now my dollar cost average is 2,500 invested, 64.57 shares, same amount. Average cost $38.71, but the stock, the current value of the stock is now a loss because I was buying shares up at prices higher than 35. So my average cost is 38. The stock is 35. So by dollar cost averaging, I'm down a little bit. In this case, the lump sum investor wins. He put the 2,500 in at $30. His shares therefore are 83.33. The stock is $2,916. The lump sum investor wins. What about rising prices? Well, let's start at the same price, and now just imagine that the fund rose the entire time. Well, you're probably ahead of me here. In this case, the lump sum investor is going to win because he put all of his money in at that low price of $30, and it's now 50. The dollar cost average investor is still up, but the average is now more in the middle of that. You know, the average price is $38.71. The stock is 50. So even though dollar cost averaging still produces a profit in this scenario, the lump sum investor that wins. And then the reverse happens in falling prices. In falling prices, what we're going to see is that the lump sum investor takes the brunt of the loss. The dollar cost averager has a loss, but because the average cost is more in the middle there, $38, the dollar cost average account takes less of a loss. So the point here is simply dollar cost averaging isn't magic. It isn't foolproof to profit. It does stretch out in investments and in fluctuating investments, especially if you get a dip in prices where you continue to buy, then the dollar cost averaging strategy can come home with more power. So there's the better. So I said before we were looking at the returns over time, compounding, and there's an old cliche quote in investing, and it says it's not timing the market, it's time in the market. And the point here is that making a decision to buy or not to buy, or to get out when you think, oh, I have to liquidate now because I'm afraid, can often result in wrong decisions. And so to sort of illustrate that, I want to go back to that chart I showed earlier. Because what I've done here is highlighted 4 big, huge months. September of 2015, S&P 500 up 8% that one month. January 2019, up 9%. April of 2020, up almost 17%. July of 2022, up 9%. And notice, as I've highlighted it, that those almost always come directly on the heels of some of the biggest drops in the month. And what this illustrates, or what this tries to drive home for you, is if you react with fear in a diversified account that's goal-oriented for the long run because the markets fluctuate, you're going to sometimes find yourself liquidating positions at the wrong time and then missing out on those big months. And there have been study after study that show that if you miss out on big years, big periods, because you get out of the market out of fear and don't get back in until after the big bounce back move, that can really destroy your long-term returns. Missing out on those big days is a very important part. And that's why staying the course, and that's why being diversified and sticking with it and having a plan to add money to it is the successful way to achieving that goal on that path that we're trying to get to, whether it's our retirement or education funding or simple wealth accumulation. So my takeaway, well, time, diversification, and disciplined savings all go together to create the powerful factors for you to reach your goals. We haven't talked about what you invest in yet. That's coming up next. We're going to start to explore, looking at the E-Trade website, talking about some of the tools for mutual funds and exchange-traded funds, the appropriate slices for the pie that you're baking. Let me invite my colleagues, if they would, to see if we can do a little Q&A. It's 12:38 Eastern Time, and we are scheduled to go till 12:45. I'll try to hold it to that because we do have another session coming up after this.
Yeah, Dave, and I'm actually kind of disappointed because we've got so many good questions. We could go easily 20 minutes on it. So real quick, this is great information. Both sessions, I think, are really dovetailing well. Is this being recorded, and where can people get that? And can they share those recordings with other people, even if they don't have E-Trade accounts? Can you talk about that real quick, and then I'll hit you with a couple of specific questions.
Yeah, you bet. So, folks, if you go to etrade.com/events or etrade.com/workshop, you'll be able to get to recordings of the things we do. And these will be available there. Also, in all of these sessions, where there is a slide deck being presented, it's available in the resources widget. That's the green widget directly below the screen that you're looking at now. You can click that, and a copy of our slides are available there. And as far as showing this to other people, you are more than welcome to forward links to these. There's no charge. This is not just E-Trade clients. If you have, we've seen many comments here from folks wanting to show these sessions to their college-age kids, which we certainly endorse. In fact, I just said after that first session to one of my colleagues, I said, I wish I'd been shown this when I was 22 years old. I would have reached things quicker. So you bet, you certainly can. I did see a question in there about the mix and achieving the right diversification. It was from Rebecca, achieving the right diversification with small amounts. That's a good point. But remember, with mutual funds, you can buy fractional shares. So you can invest the specific dollar amounts. And in many cases, more and more ETFs are getting into our automatic investing program. So there are ETFs available there, and the ability to do fractional shares in those makes them much more useful for that. But you're right, Rebecca, that's a good thing to point out. And the other thing to think about is that your mix, the stock bond mix, is likely to change over time. If you're 28 years old now starting off, your mix is going to be mostly stocks with a little bit of bonds. If you're 65 and deciding how to manage into the next 25 years of your retirement life, then maybe your mix is a little bit different.
Okay, so we haven't gotten into actually putting the money to work, but I'll be handling that in the next 15 minutes here. The question from Gerardo is, can the current value be withdrawn at any time? And I hate saying it depends, but Dave, generally speaking, this is not like a CD where you're locking up money. Can you talk just a little about it?
Right.
What if I put my money into the markets? Generally, what if I decide I need to get it out? What does that process look like?
Well, first off, the first question is, are you opening what we call just a brokerage account, which doesn't have any tax benefits, or are you opening a retirement account like an IRA or the related accounts? Those have tax structures around them. So taking money out of an IRA, because you got a tax break putting it in, you have a taxable event coming out. So that's one question. But then the other question is, so I've invested in a mutual fund and I've decided I need to sell it. Can I? Well, yeah, it's an investment that will fluctuate in value, and it may be worth more than when you bought it. It may be worth less than when you bought it. But if you do need to, quote, withdraw the money, you have to sell part of that investment, and some or all of it. So maybe you're just going to sell part of it to withdraw some cash. But remember, when you're making an investment, you are taking cash and deploying it into some thing that you're buying. To get that cash, quote, out means selling some or all of that thing. But I would also suggest that if you are investing money that you then a short time later determine you need to sell to get out, then you didn't establish the stuff we talked about in the first session, making the foundation of personal finance and wellness with the proper amount of savings, the proper understanding of risk, and only moving into investments when that money can truly stay deployed in investments. And so if you've found that you need cash, then I would suggest that you probably should have been doing something else with that cash, like paying down debt or building an emergency fund. But again, maybe I would also suggest go back and watch Aaron's first session. I think it's very helpful in that regard.
Okay, got a little bit more time left. Floodgates opened on the questions. So Dave, reference the events page one more time too, but let me throw this question your way. Christina says, what does all this mean in a bear market, which we are clearly in right now? Now, of course, there's pros and cons to being in a bear market. You just talked about dollar cost averaging. You want to talk about the timing of it, and bear market's good, bull market's bad? Where are we at here?
Well, nobody knows where the market's going next. I don't profess to know where it's going next. I just know that over the very long run, investments in U.S. stocks have produced returns better than the other things. In certain short-term periods, they underperform and markets draw down. But over the very long run, investing has produced a return, that can help you reach these types of goals. I don't know when the market's going to turn, and if we're investing in funds in a prudent way in a diversified portfolio, you shouldn't be doing that either. Now, I see a lot of questions in here that are way beyond the level that we're talking about today. So, for instance, someone we just have a question about how to use a stop order. Those are things that we do in our more advanced trading education topics. And if you go to etrade.com/events and scroll through the session on stocks, you'll see lots of related things about how to understand the various order types and how to use them, how to read charts. At the end of this session, we're going to talk a little bit about stocks, but not to that degree. But we'll give you a foundation for it. I also see a question from Adam about something called pattern day trading, and I just want to say that also is way beyond our discussion here. We're at 44. Sean, is there a single question I should try to put a coda on here? Or
I think this will kind of segue to the next one. Jordan says, how do I know? Well, we don't know anything, but how do I know if dollar cost averaging or lump sum investing is the right approach? Should you choose one method or the other based on your own needs or what's happening in the market? So that's kind of where we're going the rest of the day here. You want to wrap with that one, Dave?
Well, as my 4 examples showed, the winner of lump sum versus dollar cost averaging depends on the course that the price of that thing takes over that period. And there's no way to predict that. So I think the real question is, if you have the 2,500, it probably makes sense to just get it invested. If you don't have the 2,500 and you're doing it on a monthly basis because you're doing an automatic deposit and investing, well, then just realize the possible outcomes of that given the path that the investment takes. There's no right answer. And again, if there would be a right answer if we knew what the market was going to do for that period, but we don't. Folks, I really appreciate the conversation here, and we're really excited that so many people have shown up for this new investor workshop. We're really trying to get to the foundation of for those investors that are like, how do I do this? What do I do next? That's what we're trying to work through here, so in a very methodical way. For those folks that are asking us questions on a more sophisticated basis, stick around. I think my session in stocks coming up in the afternoon, you'll find interesting, although it is still basic level. But again, go explore our etrade.com/events. We've got a ton of webinars on more advanced stock trading ideas. This is intended to be elementary school, if you will, and we'll talk about that as being high school and college. So remember, next coming up is Sean doing Mapping Your Path, Mutual Funds and ETFs. And one more thing, we have a survey. It'll pop up in a separate window, I believe, when we shut down here, or you can bring it up in the widget below. It's the teal-colored widget. We would really like your feedback, especially if you are newer to our investment education webinars. If you're a newer investor and if you're newer to E-Trade, we would really love your feedback. I can promise you our team reviews those. We talk about what generated those types of comments, what we can do better, and what content we might be missing, and it greatly impacts the stuff we create. So really would appreciate the feedback. And thanks again for joining us. In 13 minutes, Sean Howell up with mutual funds and ETFs for the long run. Take care.